So, particularly people on the lower levels, income levels, they haven't really participated in any recovery from '08. And so it's not been a good economy for them, but it's been a very good economy for the people on top, and the stock market's been going great. So that's why I say it's a tough and complicated question. It really depends on where you sit.
Welcome to the Power and Market Report. I'm happy to welcome back again onto the show Mr. Chris Mayer. He's the Chief Investment Strategist of the Bonner Private Portfolio. He's also the author of 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. Chris, it's very nice to have you back on the show. How are you?
I'm doing well. Thank you for having me on. Always good to be on with you.
It's always a great conversation, and I'm really looking forward to our conversation today because you've started a new position. Last time I spoke with you, you were with Agora. You were writing I think it was the 100X Club or 100 Baggers related to your book. Now you're with William Bonner doing something else, so you can tell us about that a little bit.
Yeah, well, it's kind of interesting how that came about. So it was the summer of 2015, last year. We were in Vancouver at a conference, and there was a cruise for speakers, and it was late at night, and we were on this boat, and we were coming back, and we were pretty tired, and he started telling me about how he wasn't doing very well with his own portfolio, his family trust portfolio, and he was telling me that hey Chris, I'm about to violate all my principles. I'm about to turn it over to a money manager. And I said, Bill, no, don't do that, Bill. I can help you with it. And so he was like, yeah, you'll help me? I said, sure, I'll help you. And so anyway, the conversation got started there. And then I didn't see him for the rest of the weekend for the conference. And I got home Monday, and I didn't know whether anything would happen or not. Maybe it's just one of those things, you talk late at night and you're drinking a little and nobody thinks anything about it. But then I got an email from his oldest son, Will Bonner, who's like, I heard you were talking to my dad and you're willing to help us with the family trust money, so I'm here to make that happen. So, the long story short is that ultimately I wound up joining the family office at Bonner and Partners in January of this year. So
that's a great story.
Yeah.
Chris, and you already had a relationship with Mr. Bonner before, didn't you?
I've known Bill for about 12 years or so. He's been my publisher of the newsletters that I started, and then I made a deal with Agora, and I wrote for them 12 years. And so we hatched the idea for the Bonner Private Portfolio, which I can tell you about now if you want. Sure.
Before we get to that, just one quick point. I want to get your thoughts on the value of networking. A lot of being an entrepreneur is kind of fashionable now. Everyone is looking for opportunities. And myself included, I've done a lot of networking and had experiences similar to yours where you're not expecting it, but someone gives you an idea or an opportunity, and it comes at the strangest time sometimes. Can you talk a little bit about that, just your opinion on networking, how to use it, how it's worked for you?
For me, it's been huge. I mean, I travel around a lot. I go to a lot of conferences and meet a lot of people, fellow investors, a lot of companies that I've met over the years of doing this, and the contacts I've made have been tremendous and helped open up a lot of opportunities. So, it's just one of the special things about this business is that I've met a number of pretty well-known investors and people who manage significant amounts of money, have great track records, are very smart, and it's just really neat to meet these people and kind of have them on your Rolodex and have ongoing conversations, and they introduce you to other people, and so that networking element is so important. And I always tell fellow newsletter writers, especially people who are getting started early, I always tell them, leave your desk. You have to go out there, have to visit companies, visit with other investors, go to these conferences, network with people, because you never know, like you say, when these connections pay off down the road.
Yeah, and one thing that I've experienced that I'm pretty confident of is not much happens when you don't leave the office.
Yeah.
That's pretty much a guarantee.
In fact, in our business, we have a sort of a derogative term we use for people who don't leave their desk. We call them desk jockeys. So they're the ones who do all their research on the internet and Google and come up with something kind of impressive, but something that can be reverse engineered. That's the other thing is when another test kind of for a really good investment insight is how easy it is to reverse engineer. If you can just go to Google and get everything that person got, I mean, it might still be a good idea, but some of the most valuable ideas I've gotten are ones that you get because somebody told you about it or you went and you saw it, and you kind of get that original insight, original research.
That's a great point. It goes to the Warren Buffett, the moat. If you can reverse engineer it, then hundreds or thousands of people could do the same research, come up with the same conclusion, and derive the same investment thesis.
Yeah, that's right.
Okay, so let's move on and talk about your new position, because as we were talking before the tape started rolling, as they say, this sounds like the best job in the world. So tell us about this job.
Yeah, I love it. I get to, like I said, I get to travel around the world, research whatever I want to research. No one's looking over my shoulder saying, Chris, you got to look at oil stocks this month, or you got to, the whole canvas of opportunities is open. I work out of a home office here. This is my home office. The family office is in Delray Beach, Florida. And if you love investing, you love learning about businesses and love learning about people and entrepreneurs, there's no better gig, I think. So the new position is bond and private portfolio. What we did is Bill is put $5 million to invest in these recommendations. So in the bond and private portfolio, we actually have a real money portfolio that readers can kind of invest along with Bill and can see what he's doing. So this is really the stock part of the family office portfolio, or part of it. So he's also has significant holdings in gold, and cash, and his number of other investments, and this is part of that allocation. It's been really interesting because Bill, even as bearish as he is, he's at heart he's still kind of an old Graham and Dodd value investor, and he likes to get in and he appreciates the power of buying something cheap and holding on to it for a long time. And so what we wanted to do was, with the bond and private portfolios, we wanted to create a portfolio of assets that we could hold on to for years and it would appreciate in time, or we think would appreciate and be worth more down the road. So it's not something that we're putting out a pick a month. We're not trading options. We're not trading in and out of stocks at all. It's kind of the approach that a family office would take. Bill uses the term sort of generational wealth. Pass it on to the next generation.
When I heard about this idea, I thought, well, it's a fantastic idea for a newsletter. But I want to talk about it from the perspective of the family office. I'm wondering what the interest is in publicly traded companies, because if you're a very small investor, obviously you don't have very many choices. So your best option is to own a fraction of a big and successful company. If you're huge, like Warren Buffett, you also are kind of in a jam, because a lot of these private companies that you can buy are too small to warrant even your time. So you need these. But if you're, I think, a class of investor in the middle, where you have sufficient funds to go out and buy private companies, yet you're not so big that it's actually a burden. Mm-hmm. Why would you even mess around with public companies? Bill's obviously done very well with private companies in the past. What is the motivation to do this type of portfolio?
Yeah, I think there are important differences between public and private. I don't necessarily think investing in private companies is somehow easier or more lucrative, and a lot of people sort of think that. But for one thing, the disclosures sometimes with private companies are not as good as with public companies. With a public company in the U.S., a listed company, you get an enormous amount of disclosures. You really do. And even when you consider the quarterly conference calls and the other things that the company puts out, you can really learn a lot about a company and know it pretty well. And then there's a liquidity issue. When you're in a private company, you're really in it, and there's something to be said for having liquidity of being in a public investment where you could change your mind, over time. But the family office, the private businesses they invest in are ones where they have some control. I'm not aware of in private investment they've made where they were a minority investor. And they certainly favor real estate. They have a lot of real estate, and they don't hesitate to own foreign assets, cash in different currencies. That's another holding we have. So that I think that's the reason to do it, is it's something different. And in this particular case, not every family office has an in-house capability to invest in equities. It's just like anything else. A lot of the family offices just wind up hiring a consultant or investing it with a money manager, or maybe they have a number of funds. And the Bonner family office had that before. They had several outside money managers too that helped them. They were selected in different funds. But Bill is in a unique case that he publishes a lot of investment research. And I had written my newsletter for 12 years, and I think part of what sold him, he knew the work I had done, but we got a track record. We got the track record audited of my newsletter for the 10-year period that I ran it, and the results were very good, and they were at the top of the heap of the things he publishes. So that it's something, if you have the in-house capability to do stock research, and I have a lot of resources here at my fingertips. I have a couple analysts too that help me. I think it can be very valuable, but it's not something that's easy or that's necessary for everybody.
Yeah, that sounds good. Certainly a diversification play for someone who's heavily invested in real estate and gold and other things like that.
Mm-hmm.
Can you share with us in more detail what instructions you were given in terms of what metrics were important to the family office? Are they looking strictly for equity exposure and diversification in that way? Are you targeting? Just tell me what kind of parameters you were given.
Yeah, well, when it comes to the public markets, I have a very well-defined investment philosophy that Bill buys into, and one of the most important parts of that, and maybe a piece of it that makes me stand out a little from many other investors, is this emphasis on owner-operators, on people that have skin in the game, investing with people who are entrepreneurs, and where the incentives are really aligned. I like to quote, Charlie Munger has this thing he calls the iron rule of nature, which is that you get what you reward for, and if you want ants to come, you put sugar on the floor. That's what he says, and I like that quote, and I think it's the same way when you look at corporate. When you look at companies, there are a lot of public companies that their shares are not designed for the common shareholder to make any money. They're there for, the insiders make a lot of money, the lawyers make a lot of money, the accountants make a lot of money, the customers maybe do well, the suppliers do well, but they're not really designed for shareholder benefit. But there are some companies that are where the insider, the CEO or chairman owns 10 or 15 or 20% of the stock, and it's run in a very shareholder-friendly manner, where they do, smart things with their money, and they have a track record. There's a lot of, this makes sort of intuitive sense. There's an old saying that nobody washes a rental, so it's sort of intuitive that if you own the thing, you're going to take better care of it. But there's also a lot of empirical evidence about this too. There's been studies about CEOs that own at least 10% of the share of the stock and how they outperform their hired gun peers. There's studies about family controlled businesses, how they outperform stocks where they're not held by the family. So I really believe in the power incentives, and that's an important part of the investment philosophy. The only other things that Bill talks about is he's not interested in trading stuff. So he gets skeptical actually. If you start trading in and out of stuff, he's like, he's patient to a fault almost. He believes, you're buying an asset and giving it a chance to, because he's a businessman, and most business people know that you're not going to accomplish a lot in 6 months. It takes years to build something really worthwhile. Other than that, Bill is also much more skeptical about smaller cap things, so we don't get too tiny in the family office stuff. Otherwise, we're pretty free to explore all different avenues. But the Bonner private portfolio is focused on equities, but within the family office, if I come across some interesting ideas, the family office has appetite to do some different things.
Just an aside, Chris, something about your book, 100 Baggers, that I've wanted to ask you for some time is you studied companies that over several decades grew 100 to 1. And so that is basically the compounding effect of retaining earnings and growing by a pretty impressive clip. I'm wondering what your thought is on the relative difficulty of finding a company like that. So Microsoft, companies like Amazon, Microsoft, that keep doing it for decades, versus a very small company that does it very quickly. Have you thought about that? Which would, if you were going to try to get 100 to 1, which is the better, where do you think your odds are better? Trying to find a long shot that you're going to have to stick with for 20 years, or just reloading often on companies that you think can do it in a short amount of time?
Yeah, that's a good question. I think most of the companies that did it in a very short amount of time were much tougher to predict. And when I wrote the book 100 Baggers, it was, as you know, based on a study that I did of all the stocks that had returned 100 to 1 from 1962 to 2014. The book was published in 2015. And 1962 was a cutoff only because I used CompuStat data, and that's as far back as it would go. And I screened out some of the smallest stocks, $50 million in present value dollars. So I didn't want to get the little junior miners that explode every now and then, or the little pharma stocks that hit some miracle drug and spike up. And I really wanted to try to find a group of companies that had some predictive characteristics, that had a real business that an analyst might be able to look at and think, yeah, there's something here. So I think that the sweet spot is in that 20 to 25 years for the 100 to 1. Now, I also tell my readers sometimes will get hung up on this too, because they'll say, well, they're not going to wait around 2 decades for 100 to 1, and I don't know that you have to wait around 2 decades for 100 to 1, because remember, these are outstanding compounders. So if you hold them just for a few years, you're probably going to do pretty well if they're in the midst of their run. And I would gravitate more toward that, because I think I understand what you're saying, that it's difficult to find them that can do it for decades after decades, but it's a little surer path to find one that you think can do it for at least the next few years. You take a little step at a time. You buy a business that you think is a good business, ought to run for a few years, and you just kind of go with it. And maybe when you're in year 5, you find out that something's shifted and profit margins come down, there's new competition or something, and it doesn't make it. But maybe you've made good money over that 5 years anyway. So I don't get too dogmatic about that. But I do think there are a number of interesting businesses out there that are well run and that do compound at double-digit rates.
Yeah, I think that's a good point. Perhaps it's the title. It's an accurate title, but it could be misleading in the sense that if the goal is to actually get 100 to 1 on your money, maybe this is not the way. But if the goal is to get a decent double-digit return compounded, then these are the characteristics that you should look for in companies. Because like you said, it doesn't matter where in the cycle you catch them, you're going to get 15 to 20% return if you're right.
That's right. And if you wrote a book called decent compounders, it probably wouldn't sell as well as you put 100 baggers in gold letters on the cover. So I wanted people to read it too.
For sure. For sure. Okay, let's move on and talk about asset allocation. I heard you on another podcast and somewhere read elsewhere that Bill's asset allocation is something like 30% in equities, nice proportion to cash, gold, and land. Can you talk about the philosophy behind that, and then also sort of the notable absence of bonds and credit instruments in the asset allocation?
Yeah, well, I'd say the sort of guiding philosophy, and Bill writes about this, in one word would be doubt. And so Bill always, will write and have strong opinions about where the market's going to go, where gold's going to go, and I have my own opinions too. But the guiding philosophy is always doubt, that we never really know, and that ultimately we're guessing and we're making estimates, and so we hedge our bets in lots of different ways. And the 3 favorite buckets are to take a third, roughly it's about a third in equities, a third in cash, and a third in gold. for that portfolio. And then he's got real estate, which I don't include as part of that. The real estate holdings are all over the world, and who knows, what some of this stuff is worth. This is another thing that's sort of interesting. People tend to think that wealthy people know what their net worth is on a day-to-day basis, but there's a huge amount of assets, privately held land, private held companies that have no idea really what they're worth. They haven't been appraised. There's no interest in selling it, and so there's just a lot of assets there. You're not really sure what they're worth. It reminds me, there's a story I wrote about this a little while ago. I had a good friend of mine who bought a painting in 1999, and he paid $150,000 for this painting. He's a hedge fund manager in New York, and his wife thought he was crazy. This was the most he ever paid for a painting, but he really loved it, and he thought it might be a good investment. So he got it and he hung it up in his living room, and otherwise he kind of forgot about it. And then late last year, he's thinking, well, he's getting older. He wants to pay off the mortgage on his house, and he's selling some things. And so he thought, I'm gonna sell this painting, see how much it's worth. And he knew in his back of his mind that, it was probably worth more than what he paid, but he had no idea how much. So he took it to Sotheby's and they appraised it, and they said they thought they could sell it for at least $800,000. So he did pretty well, So he puts it up for auction. His wife and his daughter show up that day. They're all excited. It's like Derby Day. They got a horse in a race here, and they get to the $800,000 very quickly. He's excited. He sold the painting. Gets to $1 million. He takes a picture because they have the bid up on the wall there, and he's like surprised. I sold a painting for $1 million. I only paid $150,000 for it, but the bidding keeps going. It's like $1.1 million, $1.2 million, $1.3 million. Hits $1.5 million, and so the lady's getting ready to hold the gavel there, and someone else comes up, $1.6 million, and then it starts going again, $1.7 million, $1.8 million, $1.9 million, $2 million, $2.1 million, $2.3 million. Finally, they sell it at $2.3 million. So he's telling me this story. And I thought, well, this is one of the best stories I've heard in a long time. But I told him that, it's funny because if that was a stock, you would never have held it that long. Think about it, if you had someone coming in your office every day offering you a price for it, some days he's going to offer you $300,000, then another day he's going to offer you $75,000, then he's going to offer you half. You're going to probably sell it somewhere along the line. But the fact that he just had it shoved off allowed him to make a really extraordinary return, and that's, part of Bill's philosophy too when it comes to some of his private investment holdings is just sort of this salutary neglect. You just let it go and let it compound. I think I got off track from your original question, but it made me think of that.
That's okay. It's a good story, and perhaps there's some psychological aspect to that makes these people better investors. But the other thing I thought of, depending on your perspective, may be funny or not. A lot of rich people, they don't know what their net worth is, but there's a lot of divorced rich people who know how much they used to be worth. So let's move on then.
That reminds me, you did ask about bonds, and yeah, that's one thing that we don't have any of, and I think there are a couple reasons for that. One is, Bill is extremely skeptical of bonds and treasuries, and that being a good value at all, for reasons that, well, I assume pretty obvious, although, that trade has been wrong for years now.
Decades.
And the other part is that the corporate credit side is also, we're late cycle. We are, 8 years from the '08 market, so, nobody knows when it's going to end or not, but there's certainly all kinds of metrics you can look at to show that credit markets are pretty full and rich and well along, and this is the part of the cycle where you really have to be careful on that front. So we don't have any direct exposure there.
Yeah, let me press, because I can feel Bill's philosophy coming through here. He's obviously very sensitized to inflation, hence the position in gold. But let me press you on it a little bit. If you're prone to doubt and concerned about things that you don't know, that sounds more like a bond investor to me, not an equity investor, because the bond investor can at least use research to a greater extent to limit their risk. What are your thoughts on that?
Well, I think, we do have the family office has an enormous cash allocation. So in some sense, that is if you want to call it the deflation part of the portfolio. And I think when we think about doubt, we think about, okay, well, Bill, for example, has a very negative view on U.S. stocks, but we have some. So it doesn't, because he recognizes that he could be wrong for a while, and he has been wrong for a little while on U.S. stocks, and in that time you stand to make some good money, but he sort of weights everything. So we certainly, he doesn't have a lot in U.S. stocks, but he's got some.
Okay, I'm going to move along, get a little bit off your specific portfolio, but just ask you about some stuff that's going on in general. I'm seeing more and more news in the market about passive versus active investing, ETFs versus mutual funds. And what I see happening is more and more funds being attracted to the combination of passive investing and low-cost ETFs. And that industry is growing. You see, Vanguard was the leader, but I've seen recently that Schwab has reduced their fees substantially. I think BlackRock is doing the same, and now Fidelity is jumping in. More and more money is being pulled away from active managers and into these funds. And they're even incorporating some, they call it smart beta, so algorithmic sort of stuff. What's your feeling on that? Because I think that's going to change. It's going to change a lot in terms of active management. Before you just saw mostly cap weighted, and now all this money is going into the smart beta stuff. That's going to make that general approach less attractive, don't you think?
Oh yeah, I mean I agree. I think this is probably one of the biggest trends in the equity markets, is this trend towards passive investing vehicles. I think I read in the FT a little while ago, the estimate was a third of all assets under management are passive, and I have a feeling that number is understated, because there are a number of funds that are basically closet indexers, and it's probably much higher than that. And what really intrigues me about the shift to passive is the effect this is having on the market, or specifically on market prices of certain securities. So you have so many different ETFs, and for liquidity reasons, they can only own so many stocks. They own the larger, more liquid names, and so you find a stock like McDonald's or Coca-Cola or ExxonMobil is populated in a number of different ETFs. I was actually at Grant's conference 2 weeks ago and heard Stephen Bregman give an excellent talk about this. Stephen Bregman at Horizon Kinetics, and he had some pretty amusing examples. For example, he had I remember him talking about ExxonMobil. He said ExxonMobil is in the most popular energy ETF. It's also in the most popular dividend ETF. It's also in a value ETF, and it's also in a momentum ETF. So he talks about there being a limited number of, the supply of stocks is only so much, and these ETFs, they have to fill, they sell, they're to billions and billions of dollars of assets under management in all these different ETFs, and there are only so many stocks. They don't want to construct an ETF where they're dependent, they have to go buy these little stocks, and so you have this warping effect. So another interesting example is if you look at a stock like McDonald's. McDonald's, I think by some estimates I've seen it either 30 or 40% of the shareholder base is passive, because it's so many, it's in so many indexes. So think about what that means. I mean, that means you have 30 or 40% of that equity base is bought and held that stock, not because of anything having to do with same-store sales in McDonald's or the earnings trends in McDonald's or any of that. In fact, McDonald's growth has been pretty flat since '08. Why the stock has almost doubled, because the PE has expanded greatly, and they've taken on a lot of debt to reduce their shares. So it's more of a financial engineering return than it is a return because of what the business has done. And we see that across particularly the larger cap S&P 500 companies, where I think you've probably seen this too, where I think it was last year the S&P 500 companies paid out about, it was either all their earnings or maybe it was more than their earnings in dividends and buybacks. So I got a little off track, but the passive fund investing, I think that is a huge trend, unstoppable trend in the market now, this shift towards active to passive. And what I think, it does create some room for people who do want to do the work. Like I was just telling you, there are examples. If you have a stock that's in the ETF and is very popular, well, perhaps there are some neglected stocks that are not in the ETF. Another warping effect on the ETFs, and this is one of my favorites, is that it underweights the insider-owned companies, the owner-operators. So just to take an example, an extreme example, say you have one company worth $1 billion and you have another company worth $1 billion, but this company over here, the insiders own half of it. So as far as the index construction goes, the company where the insiders don't own any get the full weight, and the company where the insiders own half only get half a weight. So you're in fact overweight, the companies where the insiders don't own anything, which is the opposite of what you would want to do. And in fact, when the insiders buy more, then their weight falls in the index. And when they sell, their weight goes up in the index. So you think about it like that. It's really not the way you would normally invest things. So I believe that the passive investment idea is actually, I think, is a good idea. But it's a lot of things like in finance that we see over and over again, where something starts as a good idea and then it gets way overdone. So maybe, the first subprime mortgages were good ideas and then got nutty. And so, the first people who got in an S&P index fund didn't know anything about stocks. It's a good thing for a lot of people, but like any idea, it can get overdone. And I think we're seeing that now. I'm really interested to see how long this goes on and how it might end.
Yeah, a number of great points there. The first one that I'll just reiterate is that if you take all of these funds in aggregate, whether they're just purely passive or lightly managed, you put them in aggregate, it's still sort of a market cap weighted situation, because only the big companies are going to make it in.
That's right.
To a lot of these ETFs. But the other thing that's interesting is going back to our conversation where we're talking about reverse engineering strategies, doing the real work, getting out of your desk. It seems that as more of these ideas are captured in basically rules-based investing systems, those techniques are going to become less and less valuable, and really they drive up the value of a real stock researcher who can come up with sort of human ideas.
Yeah.
Ideas that require you to actually interpret data, with knowledge rather than just using rules.
I think that's right, and the other thing, I think it helps when you're a human, you can be well, I was going to say you could be more patient in a way, because the rules-based investing, sometimes a stock gets kicked out of the index relatively arbitrarily, and then suddenly you have a tremendous flood of sellers that have nothing to do with the equity involved or anything to do with the business. I mean, it's really it's an interesting subject because it just has so many different spin-off effects, and I don't know. I do think there is opportunity for people who want to do the work, and particularly in the stuff that the ETFs have underweighted. The other interesting thing about the ETFs that make them somewhat pro-cyclical is when you start an ETF, when you're a maker of an ETF, what kind of ETF are you making? You're making an ETF that you can sell. You're not going to make an ETF in a sector that you can't sell. So you wind up, I remember a little while ago, there was an ETF that was created around airlines, and I thought that was kind of interesting. And sure enough, that the creation of that ETF happened near the time when airline stocks had peaked. Everybody wants airline stocks, and so somebody's thought, hey, let's create an airline ETF. So in some ways, it's a contrarian signal, right?
I think that every time I'm watching either Bloomberg or CNBC and one of these wisdom tree commercials comes on, right. I think, oh, people are dumping this thing now.
Yeah. Oh, the other thing that's really popular, right, is low volatility. Everybody wants to own low volatility stocks. But that's another one that's really interesting because it gets down to some pretty existential questions. I mean, what is a low volatility stock? How do you measure a low volatility stock? You might look at a stock might be low volatility for the last 3 or 5 years, but maybe on 10-year basis it isn't. I think it was Stephen Bregman, again, from Horizon Kinetics, who brought up the example of, I think it was Simon Property Group. It was one of the big REITs. And if you looked at the beta, which is the way, to measure volatility, if you look at the beta over the last 3 and 5 years, it's a very low beta. So it seems to be low volatility. But if you go back, include the 08 crisis and 09 crisis, the beta on that thing was enormous. Right? It was a leveraged real estate investment. So, this is another thing. The market seems to have no appetite for high volatility. If you want to try to sell a high volatility ETF, good luck. We'll see.
Yeah. What's your opinion right now of bond proxies? Because there's a lot of discussion right now about these bond proxies with the yields being so low. People are starting to get nervous, like they're walking on thin ice with those things.
I agree. And the reason would be, again, is that some of these bond proxies, Well, ExxonMobil is probably a good example. I mean, they've spent an enormous amount of money buying back stock. They've spent an enormous amount of their cash flow every year on dividends, and yet so their overall payout ratios are higher. So those dividends are more at risk than they probably have been. And it's just I'm not sure how sustainable that is. So it's kind of strange though when you look at it and you say, okay, well you can buy a big consumer staple, Procter and Gamble, or whatever, 3 or 4% yield. That seems pretty high. I mean, it seems like a good yield. But there's a few things to keep in mind. One is the financial engineering stuff I mentioned, and things that people don't really see are like profit margins are at near all-time high. So even if you look at a company like Procter and Gamble and you looked at the profit margins for the last 10 years, if you just roll it back to where it was 8 or 9 years ago and say it's a 7% profit margin instead of 10, and you run that through what happens to earnings, it's because there's a certain operating leverage involved in these companies. The earnings are not going to fall just a little. They're going to fall like 40% or more. And then your dividend's in trouble. So the idea that bond proxies are safe depends on a lot of assumptions that I'm not sure will prove right. And so the profit margin argument is a big one. If you mean revert some of these companies on their profit margins, their earnings are going to fall a lot, for example.
Yeah, and I think that's what has a lot of people nervous. They were happy to get into it at the time, but now I think people are starting to notice precisely the things that you're mentioning here. Before I let you go, Chris, we do have a few minutes left, but let's talk about banks a little bit. I think you have been somewhat sanguine on banks, but with this Deutsche Bank stuff going on, it's got to make you think, right?
Yeah.
The idea that a fine could essentially topple a financial institution, albeit it's a huge fine, but still, the difference between 14 and 5 billion it really defines the survival of this company. So what are your thoughts on banking? Let's just focus on European banks for the time being. Do you have any thoughts on those?
Yeah, well, I'll say first that when I favored banks, they were smaller banks. I still like those banks. They're small local banks in the U.S. that you can get that are very much underlevered. I'm talking about maybe they have 25% of their assets financed by equity. So that translates into like 4-to-1 leverage. Most banks, even a well-capitalized bank, will be leveraged 8-to-1, 9-to-1, maybe even 10-to-1. A bank like Deutsche Bank is leveraged 26-to-1. And that to give you some perspective, when Lehman's last filing before it went under, the leverage was like 24-to-1. So, and that doesn't include the fact that Deutsche Bank has the largest derivative book on the planet, which is not in that leverage ratio. So to me, that was a tottering. In fact, there's an internal note that I wrote to Bill about Deutsche Bank in July, warning about Deutsche Bank. We didn't do anything about it because we don't short, but that turned out to be pretty prescient because here it is falling apart. So European banks, we don't have any. I haven't looked. Well, actually, there's some that are interesting. There are some Nordic banks that are, for example, well financed, that are conservative. They have relatively protected markets, although this gets to your point that the governments have a tremendous amount of say on whether a bank is going to be a good investment or not. And I mean, so that's always a danger. And we saw it, like you say, with Deutsche Bank. So in general, it's not an area that I'm looking at. It's not an area that I'm particularly interested in. I was in Italy earlier this year, and again, I wrote a little bit about the Italian banks. But it's still a little wobbly. I would not mess with any of those that I've seen. Maybe there's some opportunities.
It seems like that sector would be, equally in trouble. Do they have a path forward, Italian banks?
The Italian banks, that's a big debate, whether or not how much capital they need. Where's
it going to come from?
Where's it going to come from? Because as you know, the Italian government can't just print money.
Right.
So it would have to be an ECB organized rescue. But it's a little sad. Some of those banks, that I believe is the oldest bank in the world. It was one of them. I can't remember the name, but it's been around. I mean, you think about it's been around for literally centuries, and it's just sort of I don't know. It's sort of interesting to think about what finally topples it is the EU crisis. All the things that have happened in European history, have survived, and it's this. Modern banking with its uber leverage and government guarantees everywhere is what finally will make it fail.
Yeah, you're referring to Monte de Paschi, I think.
Monte, yes.
Name literally etched in stone.
Yeah.
In Italy, and now on the ropes. Just crazy. Okay, let me leave you with this. We got an election coming up. Certainly, there's going to be a lot of stuff happen in the wake of that election, even leading up to it.
Yep.
What are you expecting? Not in terms of a victory or who's going to win or whatever, but in terms of the markets, what are you preparing for come November and December?
Yeah, we've thought a lot about this, and I don't know that we have necessarily an answer that's that's greatly different than what a lot of the people are saying. But we think that if Hillary wins, it's pretty much business as usual, and it seems that she's expected to win. The polls lean her way. The betting markets lean her way. Market seems to have baked in an expectation that she'll win. And if Trump were to somehow win, it would be a surprise. And there's that old saying, the market hates uncertainty. So we believe that if Trump were to win, it'd probably create a lot of volatility around the market as the market digests that. And maybe the analogous situation is to look at what happened with Brexit. You had the UK, similar situation where all the experts thought Britain would stay in the Union, and all the polls lean that way, and whammo, we wake up surprised that they voted to leave, and the market sold off pretty hard, and the pound fell, and the pound still I think is down 15% or so on a trade weighted basis since Brexit's fallen a lot. So maybe that is something analogous could happen here, that we would have some sort of sell off on a Trump victory.
Yeah, I sort of agree with that. I think that the Hillary certainly signals business as usual. I think the markets would celebrate that, but then eventually realize that business as usual isn't actually that good.
That's right.
And with Trump, it would be the opposite. It would be concern. Maybe the markets sell off, but then they realize that, he's pretty much the same in terms of whatever, right. Federal Reserve interest rates, those types of things, and maybe his trade stuff, which is horrible, doesn't get announced, just like Brexit, Article 50 wasn't invoked right away.
And that's right. And, Brexit, the markets did sell off, but they rallied. The stock markets have come back. So it was a temporary thing where people thought, oh, my God, this is going to be a disaster. And then as people started to digest it all, it doesn't really change that much. Not immediately. And then there's always nuances, right? So there's things like, what will happen, say, for example, the healthcare stocks. Hillary Clinton has particularly spoken out against them. Maybe if she wins, not so good. So in other words, there's different sectors that might benefit from one president or the other, but it's really hard to say. And we don't really make decisions so much based on that, but it's definitely something worth considering about. It's obviously the big event on the horizon here.
Yeah. Is it accurate to say that with your portfolio, you're going to ride through with what you have, or are you putting hedges in place?
We'll ride through what we have, and if we do get some volatility, we're still sitting on quite a bit of cash, so we might, if we get a chance to add to a favorite or something, we would do that.
Okay. And I'll leave you with one more question. Last year, it was around this time I had you on. You pointed out, I think quite accurately, that look, the economy is not the stock market. The stock market is not the economy. Do we have a good economy right now?
Oh, that's a good question, because I don't know. I mean, the answer really depends on your perspective. I think for most people, it's probably not a good economy. And that's why you look at, I was just looking at some polls today that's something like only 25% of whatever this particular poll were satisfied with the way things were going in the economy, and so particularly people on the lower levels, income levels, they haven't really participated in any recovery from '08, and so it's not been a good economy for them, but it's been a very good economy for the people on the top, and the stock market's been going great. So that's why I say it's a tough and complicated question. It really depends on where you sit. But I do rest on my comments that the economy is not the market, and so some people can let their economic analysis lead their stock market forecasts, and there's plenty of evidence that they can move independently of each other for a while. You can have a very good economy and a lousy stock market, and you can have a good stock market and an economy that's not so great. So for what it's worth.
Yeah, I think so. And more it seems like bad economic news is great news for the stock market.
Can't take it down.
Yeah, exactly. Okay, Chris, I know you have to run, so I want to thank you very much for joining me. It's always a great conversation. I've been speaking with Chris Mayer. He's the author of 100 Baggers, Stocks That Return 100 to 1, and how to find them. Also, he's the chief investment strategist of the Bonner Private Portfolio. That is also associated with a newsletter. Chris, if people are interested in the newsletter, where can they go?
Well, let's go over to bonnerandpartners.com, and you can find out about it there.
All right. Thank you very much, Chris. Hope you come back again soon.
Great. Thank you for having me on. It's a pleasure talking with you.
And don't forget to visit powerandmarket.com for insightful interviews with the world's experts in investing, finance, and economics. Until next time, take care. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.